All right, so Sai said that stock selectivity is important, so I'm going to try to identify a good stock selection here for our January roundtable. And I'm actually going to lean on another roundtable. They've been around a lot longer than us, and they're pretty famous, the Barron's Roundtable. I would encourage everybody here to grab current copies of Barron's magazine that comes out. I've enjoyed this going back to the early 1990s. Abby Joseph Cohen has been one of the principal leaders at Goldman Sachs for decades. I've actually met Abby, spent some time with her. She's a fascinating lady. My other favorite on the Barron's Roundtable is a gentleman by the name of Art Sandberg. You know, his picks were a little more unconventional, but I always enjoyed seeing what was on Art's mind. He's no longer on the panel, but I did find those two have been fairly reliable sources of ideas for me over, like I say, a couple decades now. And in this January's session, Abby actually was concentrating on a theme of, you can see the larger companies here. Just as Sai was saying, the large companies have kind of been in the toilet the last 10 years. The smaller and medium-sized companies have kind of ruled. And Abby and a few other people, some of you in the group here, follow Jeremy Grantham pretty closely. Jeremy's just flat out frustrated that the larger, higher quality companies have continued to underperform here over the last couple of years. They're calling for outperformance by the larger, the UPSs, the Procter & Gamble's, and they're a little frustrated. But you can see it's a fairly short list. Abby goes on to point out that for the first time in several years, the Goldman Sachs forecast for GDP is above average. Some of the recovery from the recession is underway, so she's suggesting that these type of businesses that will benefit from a recovery seem to be in play, as well as an increase in the travel and lodging realm. And she threw Disney into that package down below. Putting those selections to a dashboard where we can, it's pretty easy to see the one that jumps off the page as to who might be attractive currently. Roche Holdings, the pharmaceutical giant global company out of Switzerland, is with a projected return in the 15% range and an excellent quality rating, pretty worthy of exploration. You can see that Morningstar has given them 5 stars recently, and excuse me for just a second. Sorry about that. 5 stars from Morningstar, strong buy rating from Morningstar, and you can see that in our combination rank of par and quality, it ranks in the top 2% of all companies. So again, I find that to be pretty attractive, definitely worthy of studying Roche Holdings a little bit closer. Here's one of the points that Abby made. It's a 3-year price chart for Roche. You can see that it's actually down fairly significantly from mid-40s to mid-30s here over the last year, and she just thinks it's been punished a little bit more than it ought to. Times are obviously tough in Europe. Times are tough everywhere. In fact, we've thought about talking about Egypt a little bit, but I think it's probably too early to know how serious that condition is. Certainly nothing to joke about. And Roche is a market leader in biotech and diagnostics on a global basis. Hugh is more qualified to talk about it, and perhaps he will have some comments for us, if not this month, in future months. But stock price is down, potentially on sale. The one thing I would warn everybody is that it does show us potentially overpriced, at least on a short-term basis. So again, I come back to size, patience, mark, patience. When we add this to the roundtable list, I wouldn't be surprised to see Roche languish for a few months, just because it has had this nice run from the mid-30s up to 38 here fairly recently. And the point I'd like to make is Abby was probably studying it down here. Abby was probably studying it for the roundtable back in that time frame.
Mark, we have a question. First of all, could you explain what it means to be on the pink sheets? And then once you explain that, are you concerned that Roche is on the pink sheets?
Okay, being on the pink sheets, there's a very broad spectrum. What the pink sheets are is basically an exchange where you're not on the New York Stock Exchange, you're not on the NASDAQ, and you're just in a different exchange mode. This is an ADR. It's an American Depository Receipt. It's treated like a normal stock. Roche does report everything pretty much in a conventional capacity, but it is on these pink sheets. There's just a number of companies that have decided to avoid whatever the qualification criteria are for that. It doesn't necessarily mean that it's a bad company, but whoever brought up the question is right to raise the caution flag, because there's an awful lot of companies on the pink sheets that are the other side of the spectrum that are really literally dangerous to hold. So no, in this case we're talking about a major global enterprise. I mean major. Go ahead, Simon.
Yeah, Mark, a good number, Nestle is another, of large non-U.S. multinational companies have elected not, as you said, not to go on to the exchanges, and in fact a few have delisted, and it's, I want to say Ross-Feingold, it's not Ross-Feingold. What's the last major?
It's Sarbanes-Oxley.
Yeah, and it's to avoid Sarbanes-Oxley. Now, all of the big companies like Roche, like Nestle, are right now voluntarily complying fully with all of our reporting requirements. So, as you said, you don't worry about those. It's the small ADRs on pink sheets that you should be concerned about. But it's essentially a Sarbanes-Oxley.
Yeah, thanks for that clarification, Si. So it's definitely there. It's a disturbing trend. In fact, I wrote about it a few months ago, this delisting that Si talked about. You have some major multinationals that are reluctant to even list on our markets. In fact, I was listening to a conference call. I don't remember the company. It was an Italian company, and they, somebody in the audience during that dog and pony show asked that question, and the chief executive answered the question. He says, in some of those American situations, and he's referring to Sarbanes-Oxley, he says, I could go to jail for making an honest mistake. And he says, I just prefer not to subject myself, nor my company, nor our shareholders to that. So it's a tough issue. All right, pressing forward. Go ahead.
Mark, we do have a couple of other questions about Roche. That question about the pink sheets came from Chris Hodgkin. Dan Hess would like to know, was there any mention of the Roche pharmaceutical pipeline? Any information on the pipeline at all?
Well, basically in the comments that I've read, and that's a good question for Hugh. It's too bad he's not able to be here. The pipeline's a little bit different, again, for some of those same reasons. This is a Swiss company. They're faced with different regulatory concerns, and I'm tiptoeing. They do an awful lot of their testing, all their various phases of testing in the international environment, and in fact, Morningstar, and I'll actually attach the Morningstar report to our session on the Manifest Forum. They do talk about the advantages that Roche has. I mean, they basically took Genentech. In fact, I'll get to that here in a second. Took Genentech as part into their stable, and they basically believe that they'll be able to move along some of the Genentech and Ventana medical product development more expeditiously because of that. So that obviously has impact on U.S. domestic sales, but from a global perspective, being expeditious is a real advantage for these guys. So, and that's what you're seeing here. I've actually taken the Morningstar data and plotted it on a visual analysis. I'm focusing in on the right-hand side of that, the 2007 through 2009 side of that, because of the Genentech and Ventana acquisitions that took place back in that 2006 timeframe. So again, we want to focus in on that because of those major acquisitions. And you can make a case for a growth rate somewhere in the high single digits, anywhere from, say, 7 to 10%. They do appear to be rationalizing and incorporating those companies into their business fairly well. Their profit margins continue to be in the high teens. So it's a fairly attractive picture longer term for these guys.
Mark, we're getting a whole series of questions about how you're getting the data into your toolkit. I know that you're not using toolkit, so could you explain where you're getting the data for Roche from? It doesn't appear to be in the data set that comes from Stock Central or from Better Investing.
Yeah, and in fact, I will attach the Morningstar report to our session in the forum, or anybody, if you're not a Manifest subscriber, feel free to write to me, and I'll send you the Morningstar report. Ladies and gentlemen, I entered these by hand. I know some of you that probably gives you the heebie-jeebies and the hives, and some of you may not even remember how to do it, but you know what? You can. And the numbers, again, trying to establish a growth forecast profile for the company, I entered by hand, right off of the Morningstar report. Now, the one on the Morningstar report could be in foreign currency. That's okay. We're only trying to establish the bigger picture there. And we'll talk a second about where some other numbers come from. So, does that take care of that question?
Now, when was it that you transitioned into Microsoft Excel, Mark?
A few years ago.
Yeah.
A few years ago.
You're just on the cutting edge of technology. I just wanted to remind everyone.
I am.
I have one last question about Roche, Bart. It's coming from Linda Schuler. She wants to know if Roche's reluctance to play in our markets would have anything to do with the exchange fees attached to the markets themselves.
No, I don't think so. I mean, I think it really does have to do with the pipeline thing that Dan is bringing up. And let me back up. They don't have any reluctance to play in. They are a major player in the United States. They have a lot of business in the United States, and one of the reasons that I really like the company is they're 55 to 60% based on oncology or cancer-related remedies and cures. So it's definitely a nice place to be in. Again, they do a lot with breast cancer and a few other types of cancer, but they're very, very active in the United States market, and in fact, they make a pretty big point on the diagnostic side of their business. They actually lead the domestic business when they're competing against General Electric, Johnson & Johnson, or Siemens. So this is clearly a major player in the domestic market. All right, let's go ahead and translate all that into how we would take a look at it. And these numbers actually do come from a slightly different place. This is your equity analysis guide for the company. Again, for those of you that are relatively new, left-hand side is a snapshot of current day business. The right-hand side is based on our 3 milestone assumptions. What might that business look like in 5 years from now? Literally closing our eyes, saying, what might Roche Holdings look like for continuing business January 20th, 2016. This number right here comes from Finance Yahoo. It's the December 2010 sales in dollars. You'll see that the shares are 3,400. Earnings, again, from that Finance Yahoo, 323. They're easy to find. Current stock price in dollars is just what Abby said it was, $38. So we're talking about a company with a PE of roughly 12, profit margins in the roughly 20% range. From our graph, we said we could see that 8% was feasible. We also said that high teens, perhaps even in the 20% range based on what I see here, and based on the analyst estimates down below, 20% makes some sense. If shares are flat, we're talking about potential earnings per share. That's a 5-year forecast, of $4.36. When we take a look at Morningstar, S&P, trying to think where else, our imputed PE ratio, we see that a PE ratio somewhere in that 14 to 15 range is feasible. The payout ratio, they pay between 2.5% and 3% historically, seems to be pretty well intact. So we're talking about a company that has a projected return somewhere around 13%, and again, that excellent quality rating of 69.5. Certainly qualifies as a buy. I would be trying to buy this company at 5 points above the market conditions that Cy talked about for a few minutes, 8.1% right now. So 13% is okay, even though it's not 15. It's okay. For those of you that wonder about when you might sell it, I just say this is how I would view holding the position going forward. I would be watching the 5-year yields. They're down around 2%, so I'd be willing to hold Roche up to 64. Just as kind of a gut check against what the analyst expectations are for the company. They see 364 at the end of next year, or actually the end of this year, at a long-term EPS growth rate of 8.7. It's not adjusted. That's actually straight off the page, 8.7. So the herd of, I should say, crash of rhinos actually sees potential for $5 per share. We really like being somewhere in slightly under that, so I take a look at Roche and say not too shabby. I'd like to add it to the portfolio. I think it gives us nice international diversification, and the thesis is a global market leader in some key areas like cancer and oncology. Makes it a pretty decent study and potential addition to our portfolio. Any questions at this point, Ken, or shall we move on?
No, Mark, we're up to date with questions at the moment, and we don't have any hands in the air, so time to move on.
All right, well, let me just insert a real quick commercial break for our Groundhog Challenge, our 5th annual contest. I don't know if the groundhogs strut or not, but you're invited to strut like a groundhog. If you're interested in participating, I see a number of people on the list that are here. I will be adding Roche to my groundhog list here for February 2nd, 2011. I see that one of our current leaders is here, Susan Macholik, and it's just a whole lot of fun. It's one of our learn by doing activities where we just try to have some fun and learn along the way. And I'll just leave you with one last thought. Groups are invited to participate, and we're really going to have some fun with this one because there's only 4 days left in the contest. And Herb Lemkool's Cherry Investment Club is actually tied with Ken Kavula's Wolves. They have the same dollars going into the final 4 days, so it'll be interesting to see how those two have in the group entry photo finish. So good luck to everybody that's participating. Again, it's no more complicated than pick 5 stocks that you think will outperform over the long term, and particularly the next year, and send them to me.